You came and sat down during the commercial break and seemed to indicate you thought this was this spelled the end of the IPO.
Well, it could.
Parade.
It could close the window for big money losers like WeWork, but really this outcome, I mean, we said last week this is not like the other IPOs, and this outcome is really off of every chart. Right? Like Uber, as we talked about here, scored out at a 6.35, so kind of a C student. So getting expelled or suspended is kind of, beyond what was called for, given the quality of these companies. So there's something else going on here.
Do you separate Uber and Lyft from the others? I mean, look, we saw Zoom, we saw Pinterest, we saw these others where there were comps. You could actually measure them against other companies. This was one of both of these companies. You just don't know where the light is at the end of the tunnel, right? Well,
so this is where the scores are sort of interesting. I don't know if you guys have this thing, but we went back and looked at them by scoring quintile. And you can sort of see that the top quintile scores, like Zoom, tend to perform really, really well on game day and then do a little better thereafter. Second quintile companies like Pinterest also do pretty well. Lyft, bottom quintile. So it's like even underperforming the bottom quintile peers there. And Uber, in the third quintile, really underperforming companies that are even a lot worse than Uber is by quality.
Dan, what do you know? Who's being screamed at over the weekend?
Well, look, everybody's being screamed at, but I think, Andrew, what you said, that thing about the other IPOs, kind of the VC-backed tech IPOs doing well, which is why I think this week's Slack deal, and I know it's not a traditional IPO, it's a public listing, but it's incredibly important for whether you want to say for WeWork or Airbnb or others to come, because if Slack does well on top of Zoom, on top of Pinterest, on top of Spotify from last year, I think that's going to say this is a ride-hail problem, not a unicorn problem.
Well, what about WeWork, though? I mean, if you're talking about a money-losing company there, a money-losing company that's losing money in a really up market, and there have been all kinds of questions about what happens to real estate.
When you see the S1 of that
one.
Right,
but Spotify loses money. But Spotify loses money. Pinterest loses money. Slack loses money.
But not at these levels. I think, when you look at what Pinterest was doing, you can see a very clear path to heading into the black, where Uber, maybe going the other way. I think, also the difference in disclosure was really significant. If you look at Spotify, they give you like the churn rates of their subscribers and stuff. You can actually build a model out of it, something that Lyft and Uber both decided very seriously to go the other way on.
So here's the question I have for you, Dan, since you spent a lot of time with venture capitalists. Clearly, for the last virtually decade, they've been supporting these prices and very high prices. Is the public market a clearly more efficient and better valuator of what's going on in terms of the value of these companies in the private market?
Whether they're a better one, they're the ultimate one, right? It doesn't matter. The venture capitalists generally ultimately sell to the private markets. So whether the or to the public markets. So whether the public markets are smarter or better, they're ultimately the arbiter. But remember, the venture capitalists, for the most part, have made a lot of money on this. It's the public market investors who dipped into private market investing that are getting killed here.